focus on HDFC Life. The insurer had guided for a 15% APE growth in FY25. But with the first quarter earnings coming in much stronger, my colleague Yash caught up with the company's MD and CEO, Vibha Padalkar, began by asking her if there could be an upward revision to that full year FY25 guidance from the 15% stated aim. Let's listen into some of that conversation.
As of now, given that there are some fairly significant regulatory changes on the anvil, we are holding what we said. Okay. Internally, of course, we're targeting a slightly higher number, but we had said 15%, which is on the upper end, on a full year basis. Yes, it's looking pretty good in terms of first 4 months, and like you said, upwards of 30%. But let's also be honest that there was a base effect.
Correct.
And so numbers for us and for everyone else is slightly looking more elevated. On a 2-year CAGR basis, it's in the mid-20s. And that's what, so it's not very different to where we are saying 15% internally targeting a little bit higher numbers. But I think I'll have a better view once the surrender charges and that new regulations are implemented. Lots of things will undergo a change. And I think right now we just want to go with focusing on business.
So 15% is the conservative view that you would want to share at this point of time, but there is an upward or a positive bias internally that you have. Is that the correct?
So. All things being equal, on the regulatory front, 1st of October it comes into being, because then you can build a business model around it, and with very little in terms of further changes. Then with the stability of business models, yes, there should be a bit of an upward bias on it.
Okay. A little on the value of new business as well. Do you expect that side, which will of course be a function of the margins also, but do you expect it to grow in tandem with the APE growth? And you've spelled out a 4-year target also towards that.
That's right.
But would it grow every year for the next 4 years in tandem with APE growth, or could it exceed that?
It's become a way of life that at least you will double your VNB every 4 years, regardless of the ups and downs. And there will be very young sector, and there will be something or the other that we have to look at from a business model change perspective. And so nothing has changed. That's what we have been delivering in cohorts of 4 years, and we will continue to deliver. Again, top line doubling and VNB doubling.
Okay.
And nothing's changed, and I want to assure you that nothing has changed. So I'm saying whether it's 4 or 4.25 years, so we are saying about 18%. Between 17 to 18% is 17.5, 18.5. You know, that kind of a range is what we have been delivering, and that's what we are internally targeting.
Now, you've said in the conference call after the first quarter that you expect ULIP share to moderate. Now, I assume that large part of that, significant part of that moderation, you are indicating that it will come because the other product categories will grow, will take a higher share, and not ULIP share will come down largely. In that situation, I want to understand, by the end of this year, with other product categories growing and taking a higher share, where do you expect the ULIP share to be over where you ended FY24? And in terms of margins, if that moves as per your understanding, the ULIP share, onto your margins, where do you see them? Where do you see yourself ending FY25 at?
I don't even have to wait till end of the year.
Okay.
We're already there. Okay, so happy to share that whatever we have said, that ULIP was elevated thanks to the markets. It's already coming close to about a third of our business. Some of our channels are sub 30%.
Okay.
Right, so it's already been achieved. Our non-par, I'm happy to share, is growing and in the first quarter itself grown by about 41%. We've already started demonstrating that ULIPs are quite at a range that we are reasonably comfortable.
ULIPs, of course, coming in the comfortable range. By the end of the year, by the next couple of quarters, which product segment do we see actually accelerating as a share of the individual APE where we stand today?
Definitely non-par. And like I said, we've just launched this blockbuster product. So that's showing very good traction. Also, in terms of the impact in the new regime, it's something that we have been talking to our partners and seeing how it can be mitigated. So if that settles down, then that segment should do reasonably well. Term is continuing to grow faster than company level growth, and so we had about 28% growth in term in the first quarter. On sum assured basis, very good numbers, about 46% on retail sum assured that we've shown growth on. So term should nicely continue to increase.
You've told me protection will grow. You've told me non-par will grow. You've told me ULIPs have come down. What does that leave you in terms of an estimation on the margins for the year?
This year, like I have articulated on our call, we're not tethered to a margin. Last year we ended 26.3%.
Correct.
I don't want to be tethered, and I'll explain why. At the same time, the caveat is we are not looking to drop margins by 400 to 500, 600 basis points, which has not been unusual in our sector.
Correct.
So I'm not talking about that margins could be free fall as long as I give the top line, like I mentioned to you. That's not what I'm saying. Now I'm saying that, like in our earlier part of today's interview, that I will grow top line, I'll double over 4 years. I will do the same thing in terms of VNB.
Correct.
Margins will be range bound, give or take 26.3, 100 basis points, 150 basis points here or there. It could be, because my focus and the ranking of priorities has been top line growth, so that we continue to be slightly higher than overall industry.
Correct.
Second is VNB growth. Margins will be an outcome of that. Only reason I'm saying that is because of unit linked. The fact that equity markets are still very, very elevated, I don't want to say no to good business, although it comes in through the door as unit linked.
So, because you had mentioned that you'd be willing to trade off some downsizing of margins against growth, just to understand that downsizing won't be plus minus 100 basis points. Is that what you're saying?
No, I'm saying it could be 100 basis points lower.
Yes, exactly.
As long as I can give you the VNB growth.
What came in that strong story for protection that we were talking about, and do you expect this to continue for some time, or do you expect this to bounce back if it was just a one-off from the next quarter itself?
Yeah, so let me deconstruct it. Like you said, retail protection, very strong growth. Credit life was flattish, and hence overall number as a percentage came down.
Okay.
Credit life, there are 2 or 3 parts into it. So the MFI book is about 1/3. And we know that the pain, a lot of the MFIs went through in Q1 and are continuing to go through.
Correct.
Similarly, some of the NBFCs are also going through fair bit of pain. And we also believe in right pricing. So what is the pricing commensurate with the claims that we are seeing? That triangulation means that little bit of slowdown that we saw. On HDFC book though, we are fairly optimistic about getting a pickup in the second half of the year.
I know I've spoken to you about growth, but I want to make the month of September an exception. October is when the surrender value guidelines kick in. Simply, I will of course get to understand surrender value and its impact from you, but simply to put it that way, is there a strong sale from the end of your distributors before the new surrender value or the higher surrender value guidelines kick in? And in that sense, could September be a very, very strong month in terms of sales, just on the back of making the most of the last 15 days?
It could be for the sector. It won't be for us. We will not do any fire sale. The paradox is these products, why is our regulator bringing out these changes? Because the products are going to be better for the customer. What is the implication of a fire sale? That means something good is going to go away and hence buy something in a hurry. The products are going to be more customer friendly. So we will stay away from a product sale. And we've had conversations with our partners that we will not do any fire sale.
Is the word coming in from Ms. Vibha Padalkar of HDFC Life.